Listen up because this is going to blow your mind. The stock market is breaking records right now, even as almost everything else in the economy is tanking. Unemployment is ticking up, inflation still won't quit, consumer confidence is near rock bottom, and the real GDP just contracted this spring. Meanwhile, the S&P 500 and the Nasdaq are an all-time high, and major tech stocks are soaring. So question is, how is this possible? What crazy forces are driving Wall Street up while Main Street sputters? Well, we're going to expose the truth in plain English. So by the end of this video, you'll see exactly why the market feels so bulletproof, even though on paper our economy looks very shaky. But first, let me ask you this question. Imagine your neighbor is worrying about layoffs and paying bills, and yet at the same time, the stock ticker keeps lighting up with green arrows. What would you conclude? Well, it sounds impossible, right? I mean, I'm sure it does. Well, that's the exact paradox we're unpacking today. Now, I'm talking about facts like the GDP shrinking 0.3% in Q1 of 2025, consumer sentiment hitting near record lows, and unemployment lingering around 4.1%. And yet, at the same time, the S&P 500 is up roughly 7% this year, and it's set multiple new all-time highs. Now, this isn't some February flash in the pan. It's happening as we speak. So let me ask you, is Wall Street in some kind of bubble, or is there something investors know that the rest of us don't know? Well, that's the question we're going to answer today on this video. So the truth is, the data doesn't lie. Now, by most measures, the US economy has been sputtering. In the first quarter of 2025, real GDP actually fell by 0.3% on an annualized basis. Now, that's a contraction at the start of the year after a 2.4% gain in the prior quarter. So we're talking about the broadest measure of economic activity shrinking. And that is normally a red flag for recession. Now, what about inflation? Well, while coming down from its peak, it's still stubbornly above the Fed's 2% target. In May 2025, overall CPI inflation was running at 2.4% year over year. Now, that means prices for everyday items are still climbing faster than normal, squeezing all our household budgets. We also have a sorely strained labor market in many ways. So the headline unemployment rate is around 4.1%. Now, on paper, that kind of looks okay, well below what it was pre COVID, but the reality, of course, is more complicated. Now, the U6 measure, which includes underemployment, is nearly 7.7%. The labor force participation rate has slipped to its lowest since 2022, and small business layoffs and hiring slowdowns are being widely reported. Importantly, consumers themselves are downright pessimistic. Now, the University of Michigan's Consumer Sentiment Index recently plunged into a record low territory. A preliminary April reading was just 50.8, down from 52.2, and that is one of the weakest readings ever. In fact, consumers are waiting for the other shoe to drop. So, in plain English, people just don't feel good about the economy. So, summing it up, the economy is limping with contracting GDP, lingering inflation, weak confidence, and underlying strain in jobs and spending. All these hard data indicators are flashing either yellow or red. So the big question still remains, why is the stock market in green? Well, the answer starts with who the stock market actually reflects. And it's not Main Street, it's Wall Street's fastest growing stars. So right now, the rally is led by mega cap tech and AI stocks that aren't representative of the broader economy. Now, look at what happened in early July 2025. Nvidia, Microsoft, Amazon, Broadcom, and other tech giants each jumped over 1% in a single day. Now, this surge in a handful of tech titans can mask the reality that many smaller companies are struggling or falling flat on their face. Now, when five companies carry 20% of the S&P by weight, their gains can lift the entire market. Indeed, analysts note that Nvidia alone is on the cusp of a $4 trillion valuation, according to Investopedia, a sign of how artificial intelligence hype is pouring rocket fuel into our stocks. Now, Wall Street investors are notoriously forward looking. They're betting on what might happen, not what just happened. So, despite all the grim news, many market participants believe that inflation is cooling and that the Fed may soon ease up on the interest rates. Major banks are now predicting multiple rate cuts later this year, according to Reuters. Now, lower rates usually mean cheaper borrowing and higher stock prices. So, if you add to that a belief that the worst of the tariff impacts are behind us and trade tensions could ease, and investors figure corporate profits will rebound. In fact, analysts point out that if hard data like low jobless claims hold up, then stocks tend to rally strongly, unless, of course, a recession occurs. Meanwhile, corporate balance sheets are flush in certain sectors. So big tech and consumer goods companies survived the pandemic spectacularly and kept on growing. A handful of themes such as cloud computing, AI, cybersecurity, even clean energy are attracting heavy investment and wild optimism as we speak. You saw it with cybersecurity firm CrowdStrike blasting to new highs as analysts called it the gold standard in its field. Even the so called boring indices like the Dow posted weekly gains. So, in short, Wall Street's glass looks half full because investors expect growth and profits to rebound quickly, even if it has been a bumpy ride recently. So, my friends, it boils down to this: the stock market is not the economy. It's a narrow set of big companies that see the light of tomorrow. All the grim unemployment headlines, the sagging confidence, and the shrinking GDP haven't translated into corporate America hitting the brakes. Well, at least not yet for the giants. So while mom and pop businesses lay people off, companies like Amazon, Apple, Nvidia, and others are investing and hiring in new technology. So investors bid their shares up. Also, central bank money printing and stimulus over the years have decoupled asset prices from reality. So, in one camp, you've got hard data saying we're in trouble, and on the other camp, in Wall Street sentiment saying, hey, things are going to be okay. And right now, the bulls are winning. So, do me a favor, if you're finding these videos informative, welcome to the Financial Freedom Network, the channel that exposes the truth behind your money, your credit, and your future. So if you care about keeping more of your hard earned cash, boosting that credit score, and staying ahead of the financial curve, well, just smash that like button and subscribe right now. Trust me, every video we release could change the very way that you live. So buckle up because this one's no exception. So let's dive deeper even still. So let me get controversial for a second. Personally speaking, it feels unfair when your savings account barely gains interest when prices are high, when your job feels insecure, and yet the rich just keep getting richer. Now, people wonder if the stock market is rigged for insiders or if there's a secret wall of money just propping it up. The reality is part structural and part psychological. On the structural side, easy monetary policy and corporate stock buybacks have just ended up pumping a lot of cash into equities over the past years. On the psychological side, fear of missing out can drive stock buying even when signs say be careful. Now, if you add the social media hype and the AI fueled mania, suddenly you've got a situation where people are piling into stocks on hope rather than the fundamentals. So let's summarize the key metrics so you can see the gap yourself. The US real GDP fell about 0.3% in Q1 2025. Inflation is still running roughly 2 to 3% annually. consumers are uneasy, and meanwhile, stock indices are up 5 to 7% year to date and continually hitting new highs. Now, these facts aren't random spin. You can verify them in government data and in market reports. What they show is a huge disconnect between economy land and market land. The financial media and the talking heads are all asking the very same question. Why doesn't the stock market care about the economy? Well, now you know, because the stock market is a forward looking, tech fueled, Fed influenced beast that only cares about a few big winners. While the rest of us struggle with high inflation, we worry about jobs. Well, Wall Street has already moved on to the next story, probably the next AI breakthrough or a Fed pivot. It's controversial, yes, but it's also factual. So, as long as corporate profits hold up and interest rates stay low, the stock indices can keep levitating. It's a risky bet, sure, because if the economy truly tanks, well, that could quickly change. But for now, the market is giving a vote of confidence in the future, even if the present looks pretty grim. So, at the end of the day, remember, your wallet and the Dow are not the same thing. Make sure that you pay attention to both of them. The stock market's performance might make headlines, but so do your paycheck, your mortgage, and your cost of living. So use this knowledge to navigate your own finances, diversify your risks, keep an eye on real economic signals, and do me a favor, don't get lured solely by the Wall Street app. And there you have it. Excuse me. The crazy truth of 2025's market. The economy might feel like it's sick, but Wall Street's party is in full swing. So stay smart, stay skeptical, and I'll see you guys in the next video. Have a great day.